Good afternoon, everyone. We welcome you to this webinar conducted and organized by ICAI Registered Valuers Organization. I need not introduce about ICAI Registered Valuers Organization, as most of the participants are registered valuers or maybe IPs or chartered accountants, those who know what is ICAI RVO. We have with us today Dr. Rakesh Sehgal sir, who is the Managing Director of ICAI RVO. Mr. Vijay Iyer, who is today will be speaking on behalf of the insolvency professionals. And we have Mr. Sumit Dadda, who is a registered valuer as well as insolvency professional. So he does both the things. He appoints the registered valuers as well as he also submits the report to the registered valuers. So with this panel, good afternoon once again to all of you to participate in this webinar. Please raise your questions, send your questions through chat so that most of the questions can be answered and also submitted at the end of the day to IBBI about the issues or challenges faced by the professionals while undertaking valuation under basically not IBC, we call it as CIRP. So whatever the issues that they are facing under CIRP, we can submit it to IBBI. And before handing over to Rakesh Sehgal sir, I would like to say a few words, although both of them do not need any introduction, be it Mr. Vijay Iyer, because he is an IP and he has handled very, very big cases like Bhushan Steel Limited, Binani Cement, etc. And he is also a fellow member of the Institute of Chartered Accountants of India and associate member of Institute of Cost Accountants of India. And Mr. Sumit Dadda, who is our regular faculty for educational course. So most of the this registered valuer know him as a faculty. I don't think they need more introduction than this. So I hand over to you, sir.
Thank you, Sarika ji, and a very warm welcome to all the persons who have joined digitally for this very important program, and of course the two panelists. It's a very important occasion because the standardization of valuation, it has been a very contentious issue and has been catching a lot of eyeballs. Well, let me cover the total perspective as to what the theme is all about. We would all know that a market economy would need valuation for various aspects. And prior to IBC, there were many enactments we were calling for valuation, whether it was the SEBI regulations or IT, FEMA or wealth tax. And for informed decision making by the stakeholders, better corporate governance, or in case of acquisitions, disposals, mergers and amalgamation, as also disputes of various nature, whether judicial, quasi-judicial or arbitration matters. But then market was trying to discover the price as different from value. And that price point, price pattern was going to be different depending upon the context for which the value was trying to be determined. Now, whether the assets or liabilities are to be subjected through the market testing, it is neither desirable nor feasible. So a professional is valuing the whole thing, and that particular point, what he arrives at, that is called as the value. Now, we all know that a wrong valuation may liquidate a viable company, and at the same time, it may rescue an unviable company, which the two situations both are disastrous. Now, the valuation therefore has emerged under Section 247. The policymakers under the Companies Act 213, they have introduced the provisions of Section 247 along with the registered valuers and valuation rules. And the ultimate intent is that the valuation for the purposes of IBC code and the Companies Act, it's a regulated profession. And the overall intent being that impartial, true and fair valuation is being carried out by this professional. And the aim is the creditor protection through the process of valuation. Now, the valuation rules, they talk about many factors. And in fact, while they provide for the entry points in terms of the qualification, licensing, and various other requirements, they talk about the matter of due diligence, maximization of value, market fairness, transparency, accountability, all these aspects. In fact, Rule 18 of these valuations rules require the valuation to be carried out by either the accepted international valuation standards or the valuation standards adopted by the concerned RVO, and in which case ICAI RVO has adopted the valuation standards issued by ICAI. Now, what all the confusion is all about? In fact, the Rule 8.3 talks about what all evaluation report should include and the conduct of valuation. So not only it is talking about the background information of the asset, but various other aspects which also include the procedures adopted for valuation and the standards followed, whether any inspections were done, what kind of evidence or material was relied upon, and of course the caveat limitations and disclosure which after 1st October 2020 valuation reports, the guidelines have come in place. Now, the entire fulcrum of IBC rests on multiple pillars, and one of them is the IP and second is the valuation professional. Now, whether you are trying to conclude the fair value or the realizable value, that it has to be credible. It is very important for the purpose of maximization of the value or attracting potential resolution applicants. Now, the kind of stakes which are involved, given that lakhs of crores of value is attached, and we have 7,000 plus CIRP as on September 2023. So whether it is the financial institutions, banks, regulators, the adjudicating authority, the difference in the valuation, because two valuation reports are permitted, and there is a provision for the third valuation report also to be taken. So is there a uncertainty in the entire mechanism? And this uncertainty path not only relates to determination of the value, but reporting of that particular value also. Now, the market risk which is attached in terms of the operation of the business has, of course, to be distinguished from valuation uncertainty, and as has been frequently told that neither it is a science nor an art, but more of a craft where along with the narrative we attach the particular numbers. So since the valuation report would have many takers in terms of, and regulatory takers, whether it is the COC, IP, NCLT or NCLAT, the multi-dimensional approaches, because there is no standardization of approaches or methodologies, or the scope of caveat limitations and disclosure, and lack of uniformity in the valuation standards, I think this poses a big challenge. While the ecosystem under the valuation rules has been created, that what all the reports should include, but many maximas and minimas in terms of how those entire thing they have to be tackled by the professional. So I think we have two learned speakers. They would be touching upon this particular aspect, and they would share their perspective and the kind of challenges they had come across. So with this brief introduction, may I once again welcome the two panelists, and I first invite CA Sumit Dhadda, who is a registered valuer, to cover his part of disposition. Thank you, Sumit, and over to you.
Thank you, Dr. Rakesh Sehgalji, and good afternoon all participants and my fellow speaker Vijayji, Sarika Singalji. Now, valuation is a 5-year-old baby, and we all know that Companies Act came in 2013 and the valuation rules came in 2018, and only because IBC came in 2016 and IBC made mandatory that the valuation rules should be passed quickly, because if we don't have a list of registered valuers, IBC process cannot kick on. We then chairperson, Mr. Sahu, knew that valuation is a very critical process in IBC, because whenever there is a debt and a lenders want to exit, they need to know what is the fair value and liquidation value they might get. So then IBC plays an important role. Now let me quickly share the slides and quickly come to the issues. So first of all, what is the need of standardization? I'm sure everybody will agree to between black and white, if things are not specified, it will be always a gray area. So we need certain standards, because till the time there are no standards set by regulators, I can do what I wish, you can do what you wish, and we both will be right, because there are no standards prescribed. Now the question comes, what kind of standards we should have? Should I have a rule-based standard which says mandates only this has to be done, or we should have principle-based standards? Overall, the preference of professionals is to have principle-based standards. Otherwise, then it will become a maths 2 plus 2 4. So principle-based standards leaves the room for a valuer's judgment to make call as when he deems fit in each situation. We'll discuss why this rule-based standard and principle-based standard is very relevant to have understanding from regulator before they standardize any valuation rules. And why we always need valuation in IBC, because we all know, we understand it is better to be roughly right than precisely wrong. Famous economist John Key says, if a buyer or seller both starts to give a value, they will always have a biasness which will be more tilted towards their objective. But then we try to find an independent professional who can try to find out what value on a given circumstances, given base of value, the asset or the enterprise may fetch. So that's why we try to get an independent person. Can we say that that independent person valuation is a gospel truth, or it's a certificate that this value is exactly the value we will get? We all will agree this cannot be the understanding. He is giving an opinion based on certain assumptions, but he tried to give to the best possible independent opinion. Now, if we do not have a standardization, then valuation will always tilt towards art. So that's how. So when I say art or science, if we make rule-based standards, it becomes science. If we have no standards, then it becomes art, which we don't like to have in, because ultimately the users of the report should have some idea where to benchmark. So if as a valuers we are giving report to all insolvency professionals, they would, if they don't have any benchmark to vet, okay, if I am giving this opinion based on which standard, then it will be easy for them to verify. Now in IBC, so valuation is for many other assets apart from normal valuations. We are specifically talking on IBC. What are the challenges and issues? Just to give a quickly brief. So we all understand in IBC, it is mandatory to have two valuations. So whenever there is any company which goes into NCLT and IBC process starts, CRP process, minimum two valuers appoint for each asset class. So ideally there are 6 valuers, 2 for each asset class. Now, what is the RV supposed to do? RV is supposed to give fair value and liquidation value. Now, the first difference we need to understand from here, the process of valuation changes substantially in a normal valuation and in IBC valuation. In a normal valuation, I value the entire organization. I value the entire company. But in an IBC, I value on a piecemeal basis, asset by asset. So if I am a SFA valuer, I will value only securities and financial assets. Somebody is a land valuer, he will value only land or immovable properties. So we are not valuing the company as a whole, and we are valuing the sum of total parts line by line. That will make a difference, because liabilities I am not touching at all. Liabilities is a prerogative of IP, he decides the claims. So our valuation is not as an enterprise value, our valuation is only for line by line, asset by asset. So that is one of the fundamental difference. Now we get two values, because since IBB understand that whenever we want to sell, one opinion might be may not be the right benchmark. So that's why they appointed two valuers, so that if anybody goes haywire, it can be easily tracked. The value is in line or out of the line. So two valuers are appointed, and generally between whatever value they give, that average is given to the IP gives to the committee. So you see that this is the ballpark figure I am getting from valuers for if you continue to the business as a fair value, if you go for liquidation, the liquidation value. Now, it is expected by RP, it is expected by RV to give a fair value and a liquidation value. Now, one point which for the thought process for members, how fair is the fair value? Now, is the CRP information in public domain? I'm sure we all will agree it is in public domain. Now, if I'm a rational buyer and I know something is into insolvency, something is into CRP, something is struggling, will I give a fair value, or I will tilt towards going for a stress valuation despite I am doing a fair value? Because the challenge is the market knows that you are into a issue, so that's why you might get a lower value. So this becomes a huge challenge for a valuer. Even if you gives the fair value, market may not value that value accordingly. So that becomes a challenge. So value tries to give you a fair value and a liquidation value. He tries to give. Who cannot be appointed valuers? I'm sure we all aware. If you're a relative of RP, relative of CD, auditor of CD, director of IP, or relative of IP, you cannot be a valuer. So one thing which the rule has given, that whenever a valuers are appointed, if it is a land and building or plant and machinery or any SFA valuer who is doing inventory, they need to do physical verification of inventory and fixed assets. So this is a mandatory condition put into the regulation, which is a non-negotiable condition. You cannot say that I would not like to go due to some reason. So let's say when the COVID was there and travel was not permitted, so condition was not waived off. Somebody need to physically go and visit. We'll come on inventory and challenges on inventory, because that is one of the burning issues for valuers. In case you get a substantially different valuation between two valuers, RP will take third valuer, because RP, the resolution professional or IP, he cannot say to the valuers that you are wrong. Suppose two valuers have given a report, one valuer would have given 100 crores, second valuer has given 150 crores. Now, we cannot expect RP to tell the valuers or go understand the nuances of valuation and say your valuation is wrong or you are over optimistic. So wherever we got significant difference, he will appoint a third valuer, and the third valuer report will come, and the closest of two will be given as the valuation. Earlier, what is the significant difference was not defined. Now they have defined in the regulation code itself that it's 25% up to. Now, should I need to go for compulsory liquidation valuation again if my CRP does not succeed? So this regulation has given you a choice. If you want to continue with the old valuation done by previous IP in the CRP process, that can be fine. Else, we need to give a new valuation if he of the opinion. If the liquidator is of the opinion he should get a valuation, then we only give a liquidation value in this. Now comes the basis of value. So we all understand in case of fair value, I will take the base market value, because the regulation says I should follow internationally accepted valuation methodology and standards. So IVS is the standard generally valuers adopt. And in IVS, the two standards which are used, two base of values, one is market value, which is synonym to fair value, and the another is liquidation value. So these are the two bases which we use. These are exactly similar to fair value of Ind AS 113 or IFRS 13. Now, in liquidation value, there are two kind of liquidations: orderly transaction and forced transaction. In case I am going for orderly transaction, my value will be always higher as compared to forced transaction. So in CIRP or in liquidation, it is not an orderly transaction. It will be a forced transaction. So my value will be generally less than orderly transaction liquidation. So that part a valuer need to always take care. Concerns, we understand for a fair value going concern, for a liquidation we are going for a liquidation premise. Now I'll quickly touch base on certain issues on valuations and certain assets. So for the first issue which always a valuer faces a challenge, whenever he got an email from RP for getting a valuation quote, he may not have the full information. Specifically in case of land and building and plant and machinery valuers, they may not have full data of what is the quantity of land, quantity of plant and machinery. They only know one number, which is from balance sheet. So proper details may not be there for giving a proper quote. And once I have given a quote, then later on I cannot say the quote is not commensurate to my work, so I will not do. Then it is not your professionalism. So that becomes a challenge on you. The biggest challenge comes is the data is not available as desired, and the data is not available because we are talking of a company which is not a regular company. The company may not be functioning properly, staff may not be there who knows all the information, RP also may not have complete information. We cannot expect RP, we cannot expect an RP to have all information because he's also a new joiner to the organization. He just joined 7-10 days back. He just become an IRP. He may not have the past information which the existing employees or erstwhile promoter will have. So because of his limitation, if he is not able to give data, we will not be able to complete. And valuation is like a concept of GIGO, goods in, goods out, garbage in, garbage out. You don't give a data, even the best valuer will not be able to give a right valuation. CD staff does not cooperate because generally we are not allowed to deal with staff of corporate data. So we generally deal with only RP. Even though RP may connect us to the CD staff, generally they may not cooperate, and they will always come with their own reason of not cooperating. That their salary is not it is due, their dues are not paid from so long. Then why should they cooperate with you? These are certain practical challenges we, as a valuer, many of you would have faced. Now, when you got some data, but then these are insufficient data, so it is very difficult for you to document. Say, for example, the simplest asset which we always encounter as a SFA valuer would be trade receivables, datas. Now, if the RP gives you a list of datas, but does not give you aging, because he does not have aging, and the system of the accounting system is not supporting, then it becomes very difficult for you to comment that you got the list, but when you don't have an aging, how can you conclude? So these are certain basic challenges. Fees may or may not come. That is, I'll always kept on the last because it is, if the company itself is not performing and we don't have a concept of advanced billing, especially in IP, they don't permit. So that becomes a challenge. Now the real challenge comes is, as a valuer, my report will be tested by either the disgruntled corporate data or the committee of creditors. Now, one of the key issues in valuation is when I submit my report, I am giving without any biases, as we prefer. But the committee of creditors, if suppose their huge money is due, so let's say banks have lended, let's say 5,000 crore rupees, let's say, and in your report you are giving a valuation of, let's say, 100 crore rupees. And why you are giving 100 crore rupees? Because first, you may not got data. The IP says I don't have a data because the CD has not given me any list of data, and for some reason you are not getting any data, or you got the data. So let's say IP has given you a list of 10 debtors. Each debtor is supposed to pay you 500 crores, and you wrote a email to these debtors also that tell me, confirm whether the money is due, and nobody is responding. Now what do you do? So as a valuer, you have a limitation. So you will say neither the I got confirmations, neither RP got the details. Now that the data is confirmed to RP, so we are giving nil value, which may be the last resort a valuer may try to put, because somewhere you need to close the engagement. Now, when you give a nil value, you think that you done your job, but do you think the COC will be willing to accept it? Because you're lowering down the valuation, COC will think that because of you, we are losing a big chunk. And that's why they question your valuation. It happened in many cases where the valuers have given zero value under conservatism principle, and the COC has went to the court, NCLT, and NCLT appointed a new valuers, and the new values came. And the reason also, I will, if time permits, I'll discuss those two cases also, where nil value was given, but in fact there was a good value. So trade receivable is probably one of the things which SFL always faces a challenge, because in terms of, if you don't get enough confirmation, enough aging details, data, then it is difficult to give certain values. There are two, three disciplinary committee judgments by IBBI recently in last year, where they question how could you give nil value to a debtor who is 2 years old and a debtor who is 10 years old. So the content of IBBI was, you cannot put both the debtors on the same level. You cannot say somebody who has not paid me for last 10 years will be a zero value, and somebody who has not even paid me from last 2 years is also having a nil value. So that's what IBA is saying. You cannot compare these two gap differences into simple. So that becomes a challenge. Now, if we give a thought how to address it. Now, suppose you may put some random percentage. You say, okay, fair value I put 50%, and liquidation value I put 20%. Even that has also been pointed out by disciplinary committee, that straight away percentage cannot be applied. You just cannot say, I had figured out fair value based on whatever approach and method, and after that I will just apply a percentage from fair value and say it is a liquidation value. That is also not considered a right approach. So somewhere you need to verify how you get these details. Cash and bank balance is probably the most simplest, but still many people goofed up in cash and bank balances. In cash and bank balances, if you take care of loans outstanding and adjust them in bank balances and say that this bank balance may not be receivable because there are certain other balances due of other loans amount, then you have given nil value. That is also not accepted, because as per the IBC, whatever loans, they cannot be adjusted against the asset. All the asset goes back to the IP, then he will decide where to allocate. Investment in unquoted shares, at many times you will find certain cases where company would have done investments and the investments would have been in unquoted shares. If you don't get any information specifically for a private limited companies or limited companies or LLP, you cannot just give zero value saying that IP has not given a detail, because these are those details that you could have easily got it from MC website, and that you can easily figure it out. So one need to be very careful. Now the challenge comes in these kind of unquoted shares is, what kind of, I cannot just apply DCF, because then I may not get full financials projections from the client. CD will not be cooperating. And if my stake is very small, so let's say my stake is 5%, 10%, I'm not even associate in that, then I may not get enough values. So that becomes one of the challenges in unquoted shares. But instead of giving nil value, it is always better to look into those numbers and find out what is the issue. Many a times we will find, in many cases, almost in all cases, client would have given short-term loans to staff or miscellaneous expenses, and you will not get any confirmation for those. And on a practical level, whenever you have given a loan to staff and the staff salary is not paid, do you think he will pay you back and say, let me return my loan and you pay me my salary? Or he will say, okay, I made a general entry on my own books, now you adjust yourself. So that becomes a challenge. Many loans at very high value loans given to staff or related parties and does not come back. Now, since we don't have any data and we don't get any confirmation of staff, it is difficult for a value to give value. So that points we'll discuss. Similar like advance to suppliers. Once you have given advances to suppliers, do you think practically they return back the advance? In many of the cases where we encountered these kind of situations, and when we asked to the suppliers that you need to return this back, please confirm. Because I am also at IP at some places. So being an IP, and I work with certain IPs too on this. Being an IP and being an RV, when I understand the nitty-gritties, many times supplier responds that now we have forfeited your advance because you have given us advance to do certain work, and based on your advance we have started the work. Now you have not cancelled the work, so delays on your part, so we will not give you anything back. So now practical problem is, if it is for a tangible, if it is for a uh, if it is for some small items, we can still take this logic that okay, advance to supplier can be cancelled, nullified. But what if it is for, what if this is for bigger items? Suppose if this is for bigger items, like if it's for bigger items like advance for immovable properties. If it is for immovable properties advance, then it becomes a challenge. I cannot just say no for immovable properties advance, because then based on certain agreements, I need to look into it recoverability and then assign fair value or liquidation value. Another challenge which we always get as SFA valuers, I'll primarily take on SFA values part, then shortly touch base land and building and plant machinery. Another challenge which we receive is, many times you will find balances due from income tax authority, maybe income tax refund, GST credits and all. It has been observed by IBBA and they've been quoted in many places that many times the client, the valuer just gives nil value considering that I have no details, so value is nil. But these details generally can be achieved. You can ask the IP for income tax login ID passwords or the details from those screenshot, and then can be worked out. So before giving any nil value on refunds on ITC credits, one need to be very careful. Many times it has been observed that certain professionals have given even liquidation value also as nil for GST credit. But then I understand, being a part of one of the COC friend in a COC meeting, the COC argued that the GST ITC credit in a liquidation also cannot be given a nil value. And one of the reasons why it cannot be given nil value was when the RP will sell the asset. When the RP is going to sell the asset in case of liquidation, in that scenario, whatever ITC he need to bear on selling of those assets, it can be compensated with that ITC credit. So that part we need to take care. Inventory now has become a biggest discussion issue from last February, when the IBC has issued certain orders, and in the district committee of IBC, they were of the view that inventory should be done only by SFA. Now that is an issue of rule based and principle based. My personal view is always inventory cannot be categorized only to SFA. It should be a principle based standard, that is, inventory should be valued by looking to the nature of the asset. So we are facing one practical problem, and these are actual practical problem, I'll tell you. So a company has made an investment in real estate. Now in the books it is coming as an investment, and investment is done in a real estate. So the SF, so the IP, it's a live case, and I'm sure but I can share the more details also. So it's a live case. IP sent a offer invite expression of interest to the land values that this is an investment in real estate and you need to get it done. So the land values refuse, saying that because IBBI has said somewhere that these are security financial assets, so we will not do that. It should be only done by SFA valuer. So they approached us that now you are SFA valuer, you need to do that. So we just said that look, this is a investment in real estate, so it is not actually a company. You just bought a land. You are shown under investment property because your friend is. So now if you appoint me to value this, then I need to again appoint a land valuer because it is not my capability to value land and building. So then instead of that, it is better you appoint land valuer. So he says land valuer is refusing. I said, what if I also refuse? So I said, we don't want to put a ball hanging, so we want to get a clarity. So he wrote an email to IBBI that please advise us who should value this investment in real estate. SFA valuer is saying it should be done by land valuer, and land valuer is saying it should be done by SFA valuer. So you please guide us. Interestingly, the regulator responded, tell the valuers to pass this problem, ask this question to their RVOs, and based on their discretion, they take their professional call. Now again, ball comes back to us, what to do. So we were of firm view that it does not make sense to why appoint, you appoint me, then appoint a land valuer, because ultimately I'll be responsible for that opinion. So I said, it's better you do that. Later on, that land valuer asked its RVOs, and their RVO said, okay, you should do it, and it got issued. Just because one order passed, everybody becomes so scared of who to take inventory and what not to take inventory. So the thumb rule which I understand for inventory should be, if the inventory is closest to the nature of land and building, should be done only by land and building valuer. If it is of inventories of, let's say, machines, products, equipments, should be done by plant and machinery valuer. Residual anything which does not fit into inventory, which does not fit into plant and machinery or land and building, can always be done by SFA valuer. Say for example of gold and diamonds. So for gold and diamonds, neither the plant and machinery or land and building are may have that adequate domain expertise, nor SFA valuer may have. But then SFA valuer can always appoint another expert from income tax or wealth tax registered or customs valuer who has expertise in valuation of this gold and jewelry and can take the input. So there has to be some guidance on inventory valuation, which will help the valuers a lot to settle. Another issue could be, we need to understand, whenever entire SFA could be a desktop based valuation. You can sit into your office and anywhere in the world and do the valuation of any company, whether be into IBC or normal. But this luxury is not there if you have inventory in your scope. Because let's say I'm sitting in Jaipur and I need to do a valuation of a company based in Delhi or Mumbai, and I have inventory in it, then mandatory I need to get it physically verified. So this cannot be ignored. But in all other SFA assignments, all other SFA asset class, you can still sit at your office and do that. Plant and machinery and land and building do not have this luxury. They need to mandatory visit whatever area they are visiting, whatever location is, and then they only need to do the physical accounting and do the valuations. Now, one more thing which normally is not available in balance sheet, but which is often asked by COC in certain meetings. Now, generally you will find all balance sheets which are into IBC will be having a carry forward losses. Now, does carry forward losses should be valued? So as of now, I have not seen any valuation report which is valuing the carry forward loss. But a food for thought is, it may happen that if I'm buying your company as a willing buyer, will I get the benefit of your carry forward losses? And if you think the answer becomes yes, then ideally it should be valued. But because it is not coming a part of asset, and because of question of virtual certainty, it is generally not valued in any of the reports. But when a buyer is buying a company, for sure his profits can always be adjusted these losses. So though it does not come in report, but for sure in terms of negotiation, COC takes care of it, because everybody knows if I am having a loss of 1 lakh crore, let's say, or 10,000 crore, I'm sure 30% at least you will get benefit. So that percent should be added in my value. But since there is no guidance on it, and since there is not forming asset as of now in balance sheet, neither in DTA, because of virtual certainty, so this becomes a challenge. Just giving you one example, in one of the old reports where the book value of debtors was 9,88,000 and the valuation report came 1 crore 12 lakhs, from 9 crore to 1 crore. And the reason was, so just to give an idea as a valuer what the best you could do, IPAI was not able to give any detail, But when he give a list of valuers, then you can always figure out that whether the company is alive on MCA or not. If the company is not alive on NCA, then you can easily make an assumption that okay, it is not going to be survive. And then whatever letters you send, whatever letters IRP sends for recovery, if they're getting it bounced, then it becomes a huge challenge. So when the address is not available, then it gives a proof for you to justify why you are giving this value. But this may not be hold good for all assignments, because if you don't have a list, or what if you have the list but the list belongs to private partnership firms or sole proprietors, then there you will not be able to get these kind of details. So that becomes a challenge. These are the two cases which I just wanted to touch base. This ICICI Bank versus Unimark Remedies, where both the values gave a value nil of a patent, but the bank COC was not happy, and COC says you cannot give a nil value to a patent, because in a pharma company the most important thing is patent. And when you are saying it is nil, it somewhere misses the key relevant point, that how could a bank would have given a loan to this pharma company which is on this patent itself. And the bank was expecting 200 crore valuation. That's what the bank expectation. But both the values have given nil. So this went into NCLT, NCLAT Mumbai, and NCLAT Mumbai asked the NCLT to again ask the valuers why they given nil. And the reason both the values have given nil was because in this company one notice came from US FDA department that we observed certain anomalies in your functioning of factory which is making pharmaceuticals. We might sanction you. So it was a threatening letter. Based on this threatening letter, they say that the value of patent should be considered nil, because they assume that if the sanction is levied, the company may not be able to sell any product. But the NCLT asked and say that there is a difference between sanction and threatening to sanction. Based on just threatening letter, you cannot give nil value. So this becomes a huge challenge, and they appointed a new value. And whatever the new value is given value, that's a confidential information which is not in public domain. But they appoint a new value, and new value give a substantial good value, and this case got closed then. Similarly, in one of the cases where Indian Bank, where two values have given a very low value, 31,700 crore in case of Solidary India Limited, but Indian Bank view was that it should be at least 18 crore value, because Indian Bank said when we gave a loan in 2013, the valuation was 14-15 crores. In 2019, it cannot be less than 18 crores, so that's what we expected. But again, NCLT called both the valuers, and this 18 crore was given by Indian Bank panel valuer only. So Indian Bank has own list of valuers. They gave 18 crore. And when again the NCLT asked both the valuers why this 31,700 value, and they confirmed that this is the right value because the asset was not transferred in the company name. The land was not transferred. Land was only assigned. So in assignment, you don't have a right to sell. So here the values did a right job, and the other valuer has taken an aggressive stand of considering the assigned asset as a real asset. So that becomes the challenge. In a IBC cases, one need to be very careful that one should not do a undervaluation based on conservative principle or based on just I don't have information, so you give a nil value. In case of a valuation where you have no value, no assets, no information, then better to give a not ascertainable value than nil value, so that you can always write in a report that I don't got information, so that's why I'm not able to ascertain the value. The moment you say nil value or zero value, you are giving a zero value, which is may not be the right answer. So it has to be not ascertainable. So I remember in one of the specific seminars, Mr. Sahu said, if the value do haircut, it is still acceptable. But if you do head cut, that is not acceptable. And what is grossly not acceptable, you do a body cut. So if you do two undervalue, considering that I have no information, you give a zero value. The example I gave of 5,000 crore asset and you give 100 crore, that does not make sense. So one need to be very careful, because your undervaluation will always lose the loss to the COC, because they will not be able to get a better value out of it. And one need to be very careful of overvaluation. If you value assets very aggressively, then the deal may not conclude, because the person who is buying has similar information available, and he also knows that this company is into CRP, so he will additionally take a haircut, so in giving a best offer. So one need to be very careful in giving these deals. This is for now. So now I think we can always hear from the. I can take queries later on. We can hear from the insolvency professional, Mr. Vijay Iyer, who actually uses the reports. So then later on, I can pitch in for anything in between.
Thank you, Mr. Sumit. So, Dr. Sehgal, Sarika ma'am, Mr. Sumit, ladies and gentlemen, respected members of the profession, I think it was a very good opening remarks by Dr. Sehgal, which was, I think, echoed by Mr. Sumit quite well in terms of being careful about undervaluation, overvaluation, and that if a wrong valuation, the repercussions in IBC can be quite dramatic. I particularly liked what Mr. Sumit called it as normal valuation and IBC valuation. So clearly, the valuation under IBC is nowhere near normal. So that, and he very well articulated the challenges one faces in arriving, what shall we say, a fair value and a fair liquidation value, and the uses that this has, and therefore how one deals with it. If, with your kind permission, may I therefore share the other perspective? I think I'm very glad that Mr. Sumit has been a valuer as well as a IP, so he understands and sympathizes with both parties, and therefore he did not butcher the RP in this case. Let me therefore try and see how we as professionals, the reason for presenting this context, and I must commend the ICAI RVO to present this side of the story as well. Because once we understand how the other person looks at our product, our services, our solution, our report, then we have a better appreciation of our own work. And therefore, consequently, if we as valuers were to see how the other person, the resolution professional or the committee of creditors, was to use our services, our product, and how do we interact with such individuals, it will help us carry out our services that much better. So with that, may I therefore share some thoughts from an RP's point of view. And I think you can see my screen fully, right?
Perfect.
Perfect. So let me try and present the role of the valuer in this entire CRP. I think Sarika madam put it very correctly, the CRP process. So where does this all fit? If I could provide a bit of context and then look at the various steps in the entire valuation exercise, which is the appointment of the valuer, the conduct of the valuation exercise, and the concerns and the issues arising therefore. And therefore the need for standardization of various matters and the continuing, shall I say, improvements that even the IBBI and the various other organizations are trying to bring that in. And then other matters related to the impact of such valuation. The first is what is the CRP? CRP, one must also be clear, what is the objective of all this? The objective of all this is to achieve a sustainable resolution of the corporate debtor. The problem on hand is that the corporate debtor is now insolvent. Insolvent does not mean it has to be liquidated. Insolvent means, as you all are the expert valuers, is that there's an imbalance in the balance sheet where the assets and liabilities no longer match with each other. The assets may be overstated, liabilities may be understated. or the other way around as well. And consequently, there's a rebalancing of the balance sheet required so as to support a sustainable business within the corporate environment. And to bring that rebalancing, it requires the rebalancing of the liabilities, rebalancing of the assets, requires multiple experts. It requires this entire process of getting the claims, managing the affairs, getting someone to look after the company, where earlier it was the promoters who are looking after the company. It is now creditor in control, the committee of creditors, who in turn task a resolution professional to take charge in a fiduciary capacity and try and achieve through the resolution process someone who could then take charge of the company, rebalance the balance sheet, ensure a degree of solvency, and a sustainable resolution. That's the objective. And in this, there are multiple, as we saw, processes and action steps required to be completed during the corporate insolvency resolution process. And during that process, we also have multiple people, multiple stakeholders getting involved. And one element that we're discussing today is the role of the valuers. And there are three key people, apart from the others, as you can see, are all getting to some way indirectly connected to the exercise. But the people directly connected are the registered valuers who provide the valuation, the resolution professional who facilitates the process. Let us be clear, the resolution professional is not the client. He is only facilitating the process. Other professional advisors that support the resolution profession, like legal advisors or someone who supports the process advisor or someone who helps in monitoring the cash flows, those, for them, the resolution professional is the client. But in case of valuers, this is one professional, the resolution professional only facilitates the appointment thereof. The key client for a valuation professional in IBC is the committee of creditors, not the RP. The RP is only a facilitator of the entire process, and therefore these three people become critical. The other people you may interact with as a valuer during an IBC process are perhaps the facilitators. The facilitators could be on behalf of the RP or on behalf of the committee of creditors, and they indirectly then put different kind of pressures. The management of corporate debtor who could either cooperate or not cooperate. The prospective resolution applicants who then also have a stake in what the valuation is. And then thereafter, of course, the adjudicating authority would then decide conclusively on what should be the next steps as far as the resolution of the corporate debtor is concerned. So this is where the role of the valuer comes into play. And therefore, one of the critical activities, and I'm sorry if I echo some of the sentiments Mr. Sumit has very clearly articulated, but it's important for us to remind ourselves the role of valuation now, which is becoming more and more demonstrably important and relevant. It is the yardstick, fundamental yardstick on the basis of which members of the committee of creditors decide on a plan. It even provides a great guide to the adjudicating authority who finally then thereafter approves the plan. And in case a plan is approved and people dissent, there is certain minimum values required to be paid to the operating creditors and to the dissenting financial creditors. And again, therefore, then the values determined by the valuer in terms of fair value, liquidation value become critical parameters under the law. It also becomes an important relevant item during the liquidation process because it's actually declared as a reserve price in any e-auction. And then finally, as Mr. Sumit said, the percentage haircut, etc. is all based on such values. It's not thereafter on the net book value, but then finally people look at the total amount of claims, and then this fair value, liquidation value, which is determined by the valuers, then become important statistical benchmarks used by various authorities as well. The first and foremost, of course, in the entire process is the appointment of valuers. This, I think, has been very clearly articulated by Mr. Sumit and also very well summarized by Dr. Sehgal in the beginning. The two registered valuers. The important thing is, again, the RP appoints the registered valuer. Sometimes registered valuers also have a firm. It is not the firm that is appointed. Finally, the person who's been appointed is only the registered valuer, unless the firm is registered as well. So one has to be careful that whoever's signing that engagement letter with the RP is one who's actually duly registered. RPs will not go and check this. They may not believe it is necessary. And then both the RP and the valuer then get into trouble tomorrow if the valuer who signs the report is actually not the registered valuer. That's important. And of course, one has to be careful that there is no conflict of interest when one gets appointed as the valuer. There are, of course, asset classes. And again, one has to be careful that one has a due registration for that particular asset class as well. As I said earlier on, I wanted to echo this, that the RP only facilitates the valuation process. Here, the RP has some discretion in identifying who he should call, get expression of interest in terms of value. One, of course, is the technical expertise as well as cost, but also does the person have bandwidth? Does the person has got experience in IBC? And then consequently, then the RP identifies perhaps 3 or 4 in the short list. And then the COC then finally pick based on cost and other elements. They provide that guidance and then thereafter approve the cost and the appointment of the valuer by the RP. So let us try and understand that even if you may engage with the RP actively, we remind ourselves that the committee of creditors is the final client. So I will encourage my professional brethren to also maintain relationships and network with the banks and financial creditors, who are after all the final users of the valuation reports, and to get an understanding of how they see valuation at IBC. What are their expectations? What else do they expect valuers to actually do or not do? It would be helpful. They will never volunteer such information, but if you go down and have a cup of tea with them, they'll give you all the insights required for us to do a better job. Next, the conduct of valuation exercise. I think, again, some of these points were very well presented by Mr. Sumit. And again, from an RP's point of view, I'll mention this. And the reason we try and put these points, I think it's important for us professionals to try and work together on solving these points. If we start doing this tutu meme that this is valuer's problem, valuer says this is RP's problem, neither of us come out as being successful, and then neither of us achieve our purpose, and then also automatically we discount ourselves in the market that we are expected to serve. So it is only in our own interest that we try and help each other. So if you as valuers find that, Mr. RP, you think you should look for this information here, Mr. RP, why did you go and talk to the GST authority? They'll give you this information which we are asking for. I'm not allowed to ask for it directly as a valuer, but you as the RP, you can ask for it. Mr. RP, you can try and get that valuer's report, which the banks had carried out on this particular company some time ago. Get that valuer's report. Maybe the bankers may say that you cannot share the valuer's report with valuers, but anything that helps us, subject to confidentiality, it would help our exercise. So that is where even the valuers can help the RP and RP can help the valuers engage themselves. I've fortunately been blessed in the sense I've worked with some excellent valuers who have given me some fantastic advice to do my job as well as to help me do their job in how they can carry out the physical verification. And the Jugaad system in India works masterfully if one puts our mind to it. I know sometimes you may not get the management support because in India, everybody says yes, but does nothing about it. But thereafter, there has to be ways around it. And if one pushes, it is possible. One important point, but particularly the last point on this slide, is this recent discussion paper which IBPI has used, because to try and avoid challenges to the valuation which is presented by the valuers. They have suggested that it has to come into force, but they have suggested that what the valuers need to do, and the RP has to facilitate this. So again, valuers and RP need to be mindful to do this, that before the valuation is finally finalized, or as the valuation exercise starts, or maybe at the beginning itself, to discuss the methodology, approach, etc., by both the valuers with the COC, get their inputs, so that thereafter the methodology or approach is not challenged by anybody. That's the proposition that IBB has placed. So suppose that is done. So as our valuers, we must be alert. Valuers need to be alert that the RP should be called upon as soon as the appointment is made. So please get this. We need to talk to COC now itself. Get their buy-in to the methodology and the process that we will follow. And then finally, they have suggested that it's only the value that the valuers will present. The valuers that the valuers present is what the RP will share with the committee of creditors, not the entire valuation report. This new process obviously will have to get into the market and see how it actually works. The reason they are trying to suggest that the entire report need not be shared is because then people start going into the report and start poking holes into the report. Rather than challenge the value, you start shooting the other elements, and therefore then you destroy the valuation report. And therefore they say that the two values is only what is shared to the, and the average of the two values. Because earlier on, the methodology process itself has already been agreed. So nobody can then challenge. To avoid challenge later on is the thought. And we'll have to see how this pans out. There are certain fundamental assumptions I know as valuers make. Likely, as Mr. Sumit said, this is not a normal valuation. And therefore, what is a fair valuation? What is going concern valuation? And there are varying assumptions, and therefore better to discuss it up front. And we have to be therefore careful right up front if there are any revisit of any change in the assumption that may lead to impact. The better to be as transparent and clear upfront. People should not misunderstand why there are certain changes being made. People may then misunderstand that changes are being made deliberately without the right intention. And therefore, engaging with the RP, engaging with the committee of creditors as soon as possible is important. And I wanted to call out that be careful of role of RPs as well. Everybody tries to be perhaps more intense, sometimes very passionate about their jobs. And we all tend to be more passionate about somebody else's job. So an RP will be very keen to tell a valuer how to do his job. And a valuer is very keen to tell an RP how to do his job. But be mindful that an RP is only supposed to facilitate, not influence. He has no role in the valuation exercise. That is entirely the domain of the valuation experts. An RP cannot get into challenging the valuer on the methodology approach, nothing. He is only to remind the valuers of the mandated requirements under IBC, provide all the information, facilitate the various visits, help in engaging with the management and other authorities to get your inputs. But thereafter, you're not supposed to share calculations, assumptions, discuss anything else with the RP. That remains the domain of the valuers. The other set of gray areas, shall we say now, which we come, is one is that it is as of the insolvency commencement date, the valuation has to be carried out. And consequently, since the books may not have been written up as on that date, as Mr. Sumit said, there are challenges to information. The reconciliation of assets to the book records becomes critical. And sometimes it is not done. And therefore, and the records may not be updated. You may have the last audited financial statements, and that may become a bit dated. And therefore, one has to try and see how best you can use the provisional financial statements or any other statements. Sometimes there's a bank, the quarterly statements which are given by the corporate data to the banks. Any other record which will then enable you to find out a list of assets is important. And why one has to become more and more creative is because now promoters are getting more creative. Management is getting more creative to suppress information. As they get more creative to suppress information, we have to stay one step ahead to get that information which we require. So there will be, title deeds. The usual answer will be no, it is left to the banks or it is left to some trustee. But then to try and pull it out from wherever it could be, it could be in the charge documents that the banks may have filed with ROC, for example. Somehow or the other, one has to pull out. You don't need, as a valuer, you don't need the original document. Even if you get a photocopy which has been authenticated by somebody to say, yes, this is the right copy, then fine. On that basis, one can proceed. Yes, the physical verification of assets has now been mandated and has been harped upon by everybody that this is critical to be carried out. But there are challenges to it. There are corporate debtors where RP itself has not got access. The promoter management has told the RP, if you wish to go to that factory, it is your risk only. We are not facilitating any visit because it is in an area which is under that so-and-so's control. And therefore, you may not get access. The RP tells the valuer, I have not gone to that factory, but you please go and do your physical verification. Now, as a valuer, whether one wishes to take that risk, it's not advisable. And then there are situations where you may find that the assets may not exist, even though they're supposed to have exited at the ICB date. There are assets which are related party owned, or they are stored in the related party premises, and they don't believe they have any duty of access to you, and therefore it is left. Then it becomes a challenge as to how are you able to complete the exercise. Then some of these are again called out upfront, discussed with the committee of creditors, so that it's it's transparent, and these issues are addressed right up front. If the committee of creditors have some solution, fine. Otherwise, it is understood that these will be the, shall I say, limitations to the entire exercise on the basis which it is carried out. It is not something someone did not want to do, but something which is one unable to do. So those limitations to the exercise would be called out in the report as well. Then similarly, there are assets, for example, if they have been categorized as being under the PUF transaction, as we call the avoidable transactions, the RP is required to identify transactions which may have been preferential in nature to the detriment of the corporate debtor, or undervalued, or fraudulent, or something which is to the detriment of the financial creditors. Consequently, you may say that certain contracts are too onerous, or there are certain assets which are actually lying not with the corporate debtor but somebody else, but belong to the corporate debtor. And the committee of creditors may tell the valuer, listen, then those assets also need to be valued. And it becomes a debate. And then you also have assets, obsolete assets, which are still shown at net book value, even though one knows that it is scrap. I think the experts know how to deal with the valuation of such. As Mr. Sumit very clearly put it, the answer is not zero. One has to find some fair value or liquidation value to such assets as well. Contingent assets, which are tricky, their expectations of the stakeholders, of the committee of creditors, is that one has to put some value to it. You may not put it in the balance sheet because it's contingent asset, but for a valuation of fair value or liquidation value IBC, the expectation is high that there will be some value even to the tax assets, even to such current assets, and which was dealt with in quite a bit of detail. And there again, it is something which requires a three-party engagement. The RP, valuers, and management need to sit down and figure out what is the history of debtors, loans, and advances. It is quite possible, as Mr. Sumit used that example, that a 2-year debt could be clearly 100% bad, whereas a 10-year debt may still be good, particularly if that company which is the debtor has gone into liquidation, for example. And there are various factors, and a lot of this is subjective based on the professional opinion of the expert. And it therefore then calls upon a layman to try and challenge that expert. Okay. Intangible assets become the most complex, whether they're truly owned by the corporate debtor or not. And then, yes, you do have the situation, I think Mr. Sumit also very clearly put it, that patent, for example, those kind of intangible assets. One where we found very complex was spectrum in these telecom companies which have gone into the CRP insolvency resolution process. And therefore, we had a lot of discussion on the methodology approach. We got technical experts also to give us some advice, and the valuers and the committee of creditors, how we deal with this issue. And therefore, thereafter, there was a determination of value as a fair value for CRP, and there was a determination of a different value on the liquidation of such items. Because who has the right to such assets if a company isn't resolved or if a company goes into liquidation? And there are different values possible for the same asset. So, ladies and gentlemen, this conduct of the valuation exercise, to summarize, as we realize that there's limited information which causes all these complexities. It requires the cooperation and availability of records, yes. Yes, the fee approval of COC. The COC are a very tight-fisted bankers. Since the company is in insolvency, they don't believe they're very reluctant to share any further fee. So whatever fee you get upfront, and what is approved, practically that only works. Thereafter, to try and get an additional fee for additional work becomes very difficult practically. You may say that I had to visit so many, I didn't realize that there was that much more work. It becomes very, very difficult. Fighting with the RP gets nowhere. I think both the RP and the valuers have to sit down together, work as professional brethren, have a cup of tea if required, have 2 cups of tea, and get it all right. Because if we start fighting, then we are a divided house. And then everybody else then beat us up, and we don't land up winning anywhere. And that is my practical input on this conduct of valuation. In terms of fair value, liquidation value, I think the clear process was called out by Mr. Sumit very clearly. But like we understand, the unsaid thing is the unsaid benchmark. The COC always has some number in mind. And like you say, and that first, there are various numbers in mind. One is what the bank will have, then what the officer will have. The officer may have been the same officer who may have approved the loan 5 years ago. And he may have approved the loan based on certain value. Now he's extremely worried that if you show a value which is 10% of that X, how is he going to be then answerable when the investigative authorities come and say, how did you approve this loan at X? So he's extremely worried and he's wanting to get that as high a value. Then you have other bankers who are trying to say as low as value so that you can get an easy resolution. And then the resolution applicants who seem to be having an active interest in this exercise will also try and see as low a value as possible. But the problem is if you start going low, then the promoters then will challenge you when you present this value, saying that you are being compromised because there is nowhere close to the real value. Because the promoters does not want to show a very low value. Because how did he then get a loan? On what basis did he then get this loan at such a high loan on if there was no assets in the company? So there are various stakeholders, and then suddenly you'll become the world's best friend or the world's worst enemy. And therefore, one has to be extremely careful to not only look at the books, but so even though one may believe that this could be exercise carried out at one's office, to engage with all the stakeholders, to try and understand the various perspectives, so that one can come to the fair value. Because the other difference is if the liquidation fair value and fair value is not very different, it can be unfortunate that a good company is pushed into liquidation, or a bad company is continued to be attempted to be resolved. Of course, the other point I think we need to summarize. Now, as I said, the IBBI and the authorities concerned are trying to bring far better clarity into various elements more and more. Earlier, it was the entire valuation, then what was asset class and all that is also now being clearly put down. What does significantly different mean? That was earlier, it was left to when we were doing this before this, we were trying to use a benchmark of 20%. We were trying to see 20% between the two valuers or 10% if between the average and the value, if that was all how it was met. Because 20% we just took because we said anything more than 20% is of significant influence under various other elements, that associated companies, significant influence, control, etc. But then I'm glad that the IBBI has come out very clear guidance on what is significantly different means, what does asset class mean. Of course, there are certain complications still left with what is asset class, as to where does land, which is an investment, fit in, as Mr. Sumit had guided us. But let us see how all that evolves as well. Therefore, this fair value, liquidation value, important to realize that value is not equal to price. I think the valuation experts, all of us, keep reminding us and reminding me as well. But it's important that we try and whoever does the valuation is able to establish that internationally accepted valuation standards have been used, that it is clear, and because it is a benchmark on the basis of which the COC would take an informed decision. And it is, like we said, the minimum payout which is required for descending creditors. 2 points which I would like to present to all my professionals, particularly to valuers as well as RPs, please. Confidentiality. We are facing a lot of flack as professionals that we are the ones found at fault for. Surprisingly, everybody under the sun seems to know the value of the corporate data other than the RP and the valuer. So I was wondering how this is happening. So if, for example, as valuers, if you find that the RP has got too much interest in this and says, I am your client, you must share all this, please be mindful that he's not your client. Second, please don't share the value too early. The RP is supposed to share the values with the committee of creditors only when he presents the resolution plans to the committee of creditors. So till such time, you can also hold on. So in fact, that's what we do. We say we'll discuss the methodology, we'll discuss all this, get everybody's clearance. You finish your exercise, you tell us you're finished, but you hold on to it. You don't share anything with us. That's as RP, that's what we say. Till we call you for that meeting when we are presenting the plans, or we tell you today we are presenting the plans, and therefore we would need the values to be uploaded to the virtual data room along with the committee of creditors. And therefore, this virtual data room again is a great way of trying to ensure uniformity of dissemination of information and maintaining confidentiality. One, because it's in one place, everybody can go and do, and all those who have signed the confidentiality agreement. That's important. And once you use something like that, and today we have multiple virtual data room facilitators. So even if the RP may not have one, my suggestion to my valuers is perhaps you could use it as well, saying I've presented my valuation report in this virtual data room, and it's possible for anybody who has signed the confidential undertaking to access it. And I have a full control of who has accessed it when. That again is something is very, very critical. That you should not share it too early and obviously not too late. Because reversing any resolution plan based on which it has been based on some perhaps an unrealistic value becomes an extreme challenge. As Dr. Sehgal also said at the beginning, if it's too undervalued, it may lead to liquidation, or if it's overvalued, we may unfairly try to sustain a company which actually should be liquidated. As we see, because if it's too low, then there's a loss of value share adds to the operational creditors as well. And there's an unjust gain to any resolution applicant and perhaps even to the promoters who may be in cahoots. If there's a delay in the liquidation process, then one may need to again repeat the process. And now we are mindful that there are actions now being taken even by the regulatory authorities against the registered valuers. I think this is a bit dated, but earlier on, it's still, I think you all are safe as valuers, whereas NCLTs and other authorities still believe that the RP is the one carrying out the value. The judges still ask the RP, how did you carry out this value? So I think we as RPs also are very keen to educate the agency authority that we are only facilitating and also the valuers. And now agency authorities are calling the valuers to explain their side of their role. And therefore RPs are hopefully not requiring to defend the valuation exercise. But we are joined at the hill. RP and value. If the value is at fault, RP is at fault. If the RP is not giving in sufficient information, it impacts the valuation exercise. So try and break us apart is not going to help anybody. That is my clear guidance to all my professional brethren. The impact of PUF is still complicated, and the impact on the valuation exercise is still to be determined. And of course, the valuation is as of the insolvency commencement date, and we are seeing sadly the CIRP processes getting extended. And therefore, what is the relevance of that value is getting more and more debated, because there is thereafter deterioration in the value of assets. There are additional liabilities which make it even more complex. And thereafter, when the COC finally meets, perhaps even after a year and a half, to actually decide on a plan, that relevance of that valuation becomes quite difficult to establish. In liquidation, if I could just briefly touch, there is one more item now which is still to be defined, realizable value. What is realizable value is still not defined anywhere. I leave it to the valuation experts. Most of them have told me that it's liquidation value and liquidation. But how that differentiates from the liquidation value during CRP, we'll have to see, and whether there is any precedent, any valuation standards which will help us give us that guidance. It is required to be valued as a going concern, as well as the various assets, as well as parcel of assets. And therefore, liquidation does become a little more complex. In fact, perhaps the value of the relevance of data becomes even less. And the personal people itself may not be there, because they are deemed to be discharged when the liquidation order is passed. And if there is, again, further inordinate delay in the liquidation, then it becomes very difficult to say that the liquidation value is a fair benchmark of the reserve price. And that complexities does arise. And therefore, ladies and gentlemen, finally, to summarize, therefore, one has to try and see that it's a transparent, fair, and competitive process for value appointment, because if otherwise, right from the beginning, if one is believed that the process was gamed, then the appointment itself is challenged. It should be as transparent, and if you have that comfort as value that the RP itself is also following a fair process, sharing information equally with everybody, then you have a degree of comfort that the process itself will also have that degree of integrity. To be mindful that an RP's role in this is only to facilitate, an active facilitation. Again, I know some RP says I have to appoint valuers, thereafter my role is over. No. The RP also is supposed to be actively engaged in trying to ensure that the valuer has all the means available and all the resources that the RP has to complete the exercise. Timelines is critical, and defensibility, as I said, one must be able to defend one's valuation and manage, and and also defend why one did not carry out physical verification if that be the cause. And the most important point, which I think Mr. Sumit also very clearly articulated, is proprietary. You have to maintain that respect or professional integrity in terms of your value, but also the interest of stakeholders to try and balance all of it. The stakeholders being the financial creditors and others who do have the valuation being impacted on what they choose to do thereafter. And therefore, Swami Vivekananda's quote becomes very most relevant for us. We are not judged by the nature of our duties, but the manner in which we conduct them. With that, ladies and gentlemen, thank you very much for a very patient hearing. I will stop sharing now, and I'm sure Mr. Sumit and I are open for any questions that you may have that we have definitely not should answer. Thank you.
Certain questions in chat box.
The method, I understand. I think there was one question, the methodology evaluation to be discussed and presented to COC by him, but it's to be presented by both the valuers. The RP is to facilitate it. That is in the discussion paper of IBBI of November 2023. And we'll have to see as it gets into it. They are expected to explain the valuation methodology to the members of the committee in a meeting facilitated by the RP before computation of the estimates. Mr. Sumit, sir, if you can take the next question.
Yeah, adding to Mr. Vijay sir, Sarakaji, this we had did last 2 months back 2 big valuations where before the valuations process started, it was RP specific request that COC is asked to meet both the valuers separately, and they need to understand both the methodologies, because they don't want it happen that I as a valuer take one methodology and the other value take another methodology, so the valuation will differ totally. And that's why they made mandatory that the valuation methodology should be on the same line, so that the number may not be much different. Otherwise, if we both take different methodologies, the number will be very different. And recently in one NCLT judgment last in December 23 only, so they questioned the RP that why you have not taken both the valuers methodology first, because in the report both methodology was different. So now it becomes mandatory that you tell the methodology in front, so that there is no last minute surprises. And regarding the question of so valuation is always an independent function. It cannot be influenced by RP COC management. But what happens is, it is because the number which I am giving, I need to defend that number. And RP always act as a mediator. He does not have any interest in that number. He will present the number given by a valuer to the COC, and COC will have again various questions. So most of the times RP handles on its own, but where the COCs are a little bit big, especially in terms of banks, they always call the valuer and RP and understand line by line the numbers and this. To my understanding, generally when we give a number, they don't say change the number. They don't say change the number, but they always say, have you looked into independent aspect? That is also challenges by COC. And off late, I'm sure Vijay sir will also agree, off late, every COC's member is taking interest in the meeting. Earlier, they were just accepting the report and going. Now, I did a case where there were 22 banks as a COC member. Trust me, the meeting started 9:30 and finished 6:30 in the evening. But every banker has to show that I asked various questions on the report, because they need to justify to their management also that we ask various questions. It comes into the meetings and minutes, so they question everything. So that way, valuation always gives the report, but don't get influenced generally by any of them. Off late, one values need to be very careful. If you have given a valuation which is absurd valuation, the CD goes and complains against you. CD says that this number is totally absurd. Let me go and buy at this price then, if that is the valuation you are giving. So the CD approaches NCLT and saying the valuation is not right. So one need to be very careful. which is just a personal question in case if I'm allowed to ask, since you deal many. Do you see very quite often that the third valuer is appointed by only RP insistence, or COC also comes in request for third valuer, even if the numbers are coming in range at times for different assets?
Yeah, fortunately, so far, appointment of third valuer has been less and less because both all valuers are now far more educated on the IBC process. And yes, you're right, sir. It is more in the prompt of the COC. Sometimes the RP also has to, but that's rare. Sometimes COC know more about the corporate data than the RP does. There will be some reason that they will not disclose why they may say that it's better for all of us to have a third value to support. Fair enough. They are the ones asking for it. They are the ultimate client. They may believe that it's required for them to justify with internally as well sometimes. And that's why their third value is appointed, even if there may not be a significant difference.
And in case of your inventories, in generally in your cases where you become IP or RP, inventory, what is generally you stand to generally take as a thumb rule?
Oh, it's very tough. It is, of course. So far, I've not picked up this different slight nuance, Mr. Sumit, on is whether is it by the financial valuer or is it by the land and building or plant and machinery. Very difficult. I'm not yet able to appreciate that fine difference. But valuation with inventory itself is extremely torturous. Well, for those who may know, I'm the infamous RP on future retail. So where inventory is one of the biggest problems there. They've had challenges in getting access to stores as well, and therefore trying to value inventory there or value the assets has been a very formidable task. And therefore, my guidance to everybody is, you have to try and use certain practical solutions on the ground where the valuer sometimes with somebody from the corporate data side or even from the RP team side or someone local, quietly go and get into that store, look at everything, physically verify, take photos. One way is to take photos that you have evidence, and then being able to establish values. Today, thanks to mobile technology, everybody has got a camera and even a video.
In fact, there is a valuation which is coming on standard also, I think, in the discussion with IBC on automated valuations by drones and other things for land building and plant and machinery valuations.
It's a very good point you're making. In one recent exercise, I must commend, there was a earlier RP who initiated the GPS testing, that GPS identity tracking, GPS tracking. So, because there were certain critical assets, high value assets. And therefore, if you get that GPS tracker, then you're able to identify the location of the assets at all times. Very valuable exercise. It establishes physical location, establishes high value assets, high value machinery. And now that is one thing which is it's now not yet mandatory in the CRP regulation. It's something which is encouraged. And therefore, if you find situations where you have these high value assets or even land building, etc., this is one way the valuers, along with the other institution or the other service providers provide this, is a way of doing it. It establishes the physical verification of such assets as well.
One member has requested if it's possible, valuations done in the context of issuance of equity rights issued in listed and unlisted entities.
So I can just touch base quickly on certain points.
Please.
So the right issue is always in a concept of Companies Act. Income tax have no such word right issue. So income tax, any issue is a issue. So one valuation under income tax will be separate, one valuation under right issue will be separate. In a listed entity, a lot of members are of the view, those who have not gone the rules carefully, they are of the view that I should only take market value. So SEBI has rejected 2 reports of registered valuer recently, where they only took the market value because it's a listed company. So the first logic is always that whatever is coming on stock exchange last 10 days price and 90 days price, which is a trading price, is the best benchmark. But this is not relevant if whenever in any listed company you are making a issue more than 5% of the capital. So suppose the paid up capital is 1 crore and you are issuing 10% shares, then mandatory you need to use all three approaches. So the exchange has rejected the report and they give a remark that you need to use all three approaches and then tell why you are not using particular approaches. You just cannot take market value because that's not expected when you are going more than 5%. So even the regulation 164A specifically mentions in LODR regulations, whenever you are issuing capital more than 5% in a listed entity, you need to apply all three approaches. And then you need to justify why. Let's say for some reason client does not give you DCF, saying that because of our confidential information, our projections may go out in public and I don't know to share, then you need to write. But even then, on this exchange has not appreciated this approach, saying that why you cannot share confidential information of projections. So they say you just give the basic numbers and issue the report. So in terms of listed company, where you are just issuing less than 5%, you can always take market approach. That is minimum 10 days and 90 days volume weighted high average. You can that is a benchmark. You can always issue more than that. In terms of listed more than 5%, you need to mandatory use all three approaches. In case of unlisted companies, in case of right issue, a right issue does not mandate a valuation, because you are giving equal opportunity to everybody. So in Companies Act, if you don't do a right issue valuation, it is still considered okay, because post right issue, economic interest does not get impacted of any of the existing valuer, because everybody gets equal chance in right issue. But in case of fresh issuance or in case of preferential allotment, in case of private placement, you mandatory need to get the valuation report done. One question which a lot of people at times get confused: I want to issue a redeemable preference share of at par to be redeemed at par and at a, let's say 7% or 8% of dividend. Do I need to get a valuation? Lot many people say we don't need it. They ignore the valuation. But if you again read section 62(1)(c), section 62(1)(c) applies for issue of shares, and preference is also a share. So whenever you're issuing a share, even if it is a preference, even it's a redeemable preference shares, you mandatory need to take a valuation report, mandatory. So you need to be very careful when you're issuing shares, especially preference shares. You need to take it. In case you are issuing compound instruments like CCPS and CCD, then depends on terms and conditions of the conversions. You need to always issue that shares based on your terms and conditions. If you are having 1:1, then you need to always get a valuation of the underlying asset also at that time. And if you are having at the future value or based on certain assumptions, then you need to apply back solve and other methods. Depending on the terms, you need to get the valuation of preference shares. And in case of issue of equity, if you are issuing equity, you can use any methodology. It is preferred to have looked into all three methodologies, especially when you are issuing to a foreign investor. You need to ensure that you look into DCF and market multiples approach mandatory. You just not take cost approach, because at times authorized dealer asks the question that why have you not looked to other approaches. So whenever you are doing any valuations for a fresh issue of equity, I need to consider all three approaches, and based on the values call, whatever approach suits you best, you can take that. And that is what we were talking earlier about principle based standards. So the principle gives you that there are three approaches. Whatever gives you maximum comfort and you are able to justify, you can use that approach. But it's not mandatory for you to use all three. You should look into all three, take the comfort in maximum whichever you are getting, and you can use only one approach and take accordingly. That's broadly on valuation when you need it for equity shares and listed companies, unlisted companies.
Thank you, Sumit. If I may ask any three major pointers which you would like our audience to remember as key touch points, key outcomes that they need to take into account when performing their role as valuers, and same question to IF sir also, uh, IP. So what are those three key areas that they should be definitely taking into account?
Okay. So regarding valuations, my few points which I think one should take care. So one should mandatory write base of values in the report and specific standards in the report, because based on the disciplinary committee orders, many places they noted and commented that the valuers has not written the specific base of values, specific standards in the report. So even though you have done the absolutely perfect valuation, you have done all best thing, but if it is not documented in the report that you have used on what approach, what base of value, it becomes a challenge for the regulator to justify. So, and second thing, the regulator expects that whatever assumptions you are taking should be well articulated in the report, so that nobody else need to look into something else and figure out. So if I'm saying, okay, for a 10-year data I'm putting zero value, and for a 2 years data I'm giving 80%, so I need to write my rationale somewhere in the report. So that part should be always taken. And third, nowhere your confidentiality should be compromised, because in the classic case of video call, it was questioned that how come the value has gone into public and how come the bidders is quoting exactly near to the value, the liquidation value. So either someone from valuation team would have compromised the independence and would have disclosed the value, or someone from any office. If it is come to know that someone has from our office would have dealt, it would be taken very aggressively by the regulator. So one need to ensure that as much as secrecy needs to be followed, one need to ensure that number does not get public. And nowhere, let's say, for example, let's say if I did do a valuation of, let's say Ruchi Soil Limited, let's say I have not done it, but let's say I do that. So nowhere in any forum I can say, oh look, I valued Ruchi Soil and I give the valuation of X amount. I can always say I was a valuer of Ruchi Soil, but I should never disclose the numbers in any forum, because once you disclose, you are breaching the confidentiality, and it is NDA which is signed by you on any manner. So that part need to taken care mandatory. Vijay sir.
Thanks, sir. Thanks, sir. As an RP, there are 3 points. One is, of course, right to the upfront when you appoint valuers, please ensure that you have a transparent, fair, and clearly visible process of appointment. And it's a competitive process. Share as much information that you can about the corporate data so that you have the valuers giving you an informed decision. They don't feel cheated either by the RP or anybody else that they underquoted for this project or they underestimated, and thereafter there is further increase in scope. So please, as RPs, be as professional as possible. Engage with the valuers, understand and let them appreciate the challenges that they would face in carrying out the exercise. First. Second, as an RP, during the process, please understand your role. You are only a facilitator. You are not the user. So avoid influencing. There is a thin line. You're supposed to facilitate but not influence. Actively participate. Don't be a passive demonstrator in the sidelines. And please ensure that the valuer has all the support available to carry out the exercise. And last, protect the valuer. There will be multiple stakeholders pushing from here and there, trying to influence the valuation. As an RP, you are an officer of the court, so you do have certain, shall I say, jurisdictional rights, and there are psychological pressures. You can say, please let the valuer carry out his job. Tell the promoters and management to behave in terms of giving information. Tell the committee of creditors to also perhaps be a check, and tell them not to unnecessarily pressurize professionals to achieve certain values that they may need for other purposes. And that way, when we as professionals protect each other, I'm sure the outcome will be successful, sir. Thank you.
Well, thank you so much, Vijay Iyer Saab and Sumit ji. Uh, Both the talks were very insightful and most emphatically because you covered live examples, your insight and experience over the years that you have accumulated. So that's a big learning for all of us since the subject matter itself is evolving and we are at the nascent stages. Possibly a lot of value is yet to come up. And because IBC code itself, they are saying it's a dynamic law and things are changing every day. So, but the kind of knowledge that you brought about in today's session, both of you, I must thank you for all the exposition and all that was very insightful, very useful. And I think while we at RVO have gained a lot from your talk today, and I'm sure that the valuers, IPs, and the members of the institute who attended today's session, they would have gained by this exposition. And if there are any questions still left out, we are there. And the presentations, if the authors permit us, they can be put on the site of the ICAI RVO. So with that, I once again, on my own behalf, on behalf of ICAI RVO, thank you for your time, Iyer Saab and Sumit ji. You both have been very cooperative and you are always available whenever we called you. And thank you so much. It's a collaborative learning. And I think in times to come, we'll have more and more collaboration with you and, of course, the members. Because ultimately, our thought process is that the capacity building of profession takes place. And this is a profession is still in very young phase. So with more and more learning and expert dimension, because those who have dealt with the real-time cases, possibly they can share more. So thank you so much. And I think it was wonderful having you and the members would have gained. With these words, I close this session. Thank you for now. Thank you.